On one hand, you get the chance to trade more without putting in fresh capital. On the other hand, you want to know where to use that capital or margin so that you can make most of it. Once you have both, it's a win-win, and honestly, who wouldn't want that? In this video, I'll explain how you can trade more through pledging for margin and how to use that margin smartly to get the best out of it. Let's start with understanding what the pledge for margin means. Pledging is like saying to your broker, "Here, keep my shares as security or collateral and in return, lend me some extra money to trade." Let's make this simple with the help of an example. Meet Gagan. He owns shares worth 2 lakh rupees in his Demat account. Now, just like how you might take a 10 lakh loan by keeping your 15 lakh property as collateral, similarly, Gagan can pledge his 2 lakh shares and get, say, around 1.7 lakh as additional margin. And here's the interesting part. He doesn't even have to sell his share. That 1.7 lakh margin can be used for buying more shares, trading in F&O, or even intraday trades. In short, pledging gives you flexibility to scale up your trading positions without putting in fresh capital immediately. And now, coming to those 2 tricks that can help you to use that margin smartly to get the best out of it. Trick number 1 is to use liquid collateral instead of non-cash collateral. And trick number 2 is to use covered calls. Before I explain these 2 tricks in detail, it is very important for you to understand these 3 features first. Feature number 1 is that not all shares can be pledged for margin. Only the approved ones. Also, it's not just shares that you can pledge. You can also pledge liquid Bs ETFs, liquid fund, equity ETFs, and even mutual funds. You can find the list of these securities either on your broker's platform or on the NSE website. Feature number 2 comes to the question, how much margin can you get? Well, that depends upon haircut. By haircut, we mean a percentage reduction applied to the market value of a security when it's used as collateral margin trading. This reduction creates a safety buffer for the lender against potential price drops and market volatility. For example, if you have pledged shares worth 10,000 rupees with a 20% haircut, you would receive only 8,000 as pledged balance. The remaining 2,000 is held as a risk buffer by your broker. But the percentage isn't same for every stock. It varies. Risky and volatile stocks usually have a higher haircut, while stable ones have a lower haircut. To give you an example, let's say Gagan has 2 stocks in his Demat account. One is Adani Enterprise and another is Axis Bank. Both are worth 2 lakh rupees each. Now the haircut on Adani Enterprise is 17.76%. So even though the stock is worth 2 lakh, Gagan only gets 1,64,480 as margin. On the other hand, Axis Bank has a haircut of 9.08%, which means he gets 1,81,840 against the same 2 lakh rupee value. So the margin you actually get depends not just on the value of the share, but also on the haircut. And yes, these haircuts can change over time. Coming to the last feature, feature number 3, is the one thing that's common across all brokers is the pledging charges. Every broker charges a fee for pledging your shares, but the amount may be different from broker to broker. For example, if we take Zerodha, their pledging fee is 30 rupees plus GST per stock, no matter how many shares you pledge of that stock. So pledging 10 shares of Infosys costs the same as pledging 100 shares of Infosys, that is 30 plus GST. But if you pledge 10 shares of Infosys and 5 shares of HDFC Bank, that's 2 different stocks. Then you will have to pay 30 rupees plus GST for each stock. And lastly, unpledging is free, which means no charges when you unpledge your shares. But there are interest charges as well. See, if you pledge liquid Bs or liquid funds, they are treated as cash collaterals, basically cash and cash equivalents. But if you pledge stocks, equity ETFs or mutual funds, they are treated as non-cash collaterals or equity collateral. Now, when you use that pledged margin to trade FNO, the exchange requires that at least 50% of the margin must be in cash or cash equivalent collateral, while the remaining 50% can be non-cash collateral. If there is a shortfall in the cash margin requirement for overnight position, and that is funded by non-cash collateral, then an interest of excess collateral used will be charged, which is 0.035% per day or 12.775% annually on the shortfall. To help you understand this better, let's take Gagan's example only. He pledged his shares and liquid Bs, and after the haircut, he got the margin of 1 lakh for his shares, which will count as non-cash collateral, and 50,000 for liquid Bs, which will count as cash collateral. Now let's say Gagan wants to take an FNO position that needs a total margin of 1 lakh rupees. Then even though the non-cash collateral of 1 lakh rupees is sufficient, but as per the rule, 50,000 cash collateral will be used and the other 50,000 can come from stocks. But if Gagan only had 1 lakh in stocks and no liquid Bs, then the cash requirement of 50,000 would be missing. That shortfall would be funded by his stocks, and on that portion, the exchange would charge the interest of 0.035% per day, which is 17.5 rupees per day. Now that you've understood the basic features around pledging for margin, let's discuss those two tricks. Trick number 1 is to preferably pledge liquid collateral instead of non-cash collateral, and there are 2 simple reasons for that. Reason number 1. When you pledge cash collateral, you get more margin to trade with. For example, cash collateral like ETF have only 6% haircut, which means you get 94% as margin. In case of SGBs, liquid fund, treasury bills and government securities, they have a 10% haircut and you can get 90% as margin. But with stocks, equity ETFs and equity mutual funds, the haircut depends on how volatile that instrument is, so the margin you get can vary a lot. Reason number 2 is, with cash collateral, your asset continues to appreciate in value and you don't need to worry about margin calls. But with non-cash collateral like stocks or equity funds, if the market falls, the value of your pledged asset also falls. That means your margin reduces and your broker may ask you to add more margin. Suppose Gagan pledges 1 lakh worth of liquid Bs and he gets 94,000 margin for the same. Since liquid Bs trade close to 1,000 per unit and don't fluctuate much, Gagan does not have to worry about sudden value drop or margin calls. Now imagine if Gagan pledges 1 lakh worth of volatile stock instead with a 20% haircut. Initially, he is only going to get 80,000 at margin. But the stock price fall of 20% and now his collateral is worth only 80,000. Now, if you apply the haircut on this new value of 80,000, which will be further reduced and you will only get 64,000. That's a big shortfall and his broker will ask him to bring in extra margin. If he can't arrange the funds quickly, his position could even be squared off. Therefore, with non-cash collateral, there is always the risk of margin calls and forced selling, but that is not the case with the liquid collateral. Now coming to trick number 2, that is about covered calls. Let's say your portfolio only has equity instrument and no liquid instruments. In that case, if you still want to explore more trading opportunities, you can go for covered calls. Here's how it's worked. Suppose Gagan owns 500 Reliance shares which are currently trading at 1360 rupees each. That means his holding is worth 6,80,000 rupees. He pledges these shares and after a haircut of 9%, he gets about 6,18,000 as his margin. Now with this margin, he sells a Reliance call of 1,400. Say the premium for this 1,400 call is 15 per share. So for one lot for Reliance, which is 500 share, Gagan gets 7,500 rupees upfront in his account. Now, if we take both the scenarios, that if Reliance goes above 1,400, in that case, Gagan makes a profit on his share since he holds them. even though the call option he sold will cost him money, the rise in the share price offsets that. Now, the other scenario, that is, if Reliance stays below 1400, the call option expires worthless and Gagan keeps the 7500 premium as profit. But remember the interest charges that we discussed? In order to take F&O trade, Gagan would need a margin of 1.1 lakh, which means 55,000 can be non-cash collateral, which is his Reliance shares that can fulfill for. But for remaining 55,000, he needs cash collateral. In case he has no cash collateral, like in this case, then the entire margin is taken from Reliance shares only. And in that case, Gagan has to pay the interest of 19.25 rupees per day. Now let's quickly understand that how can you pledge for your margin. You need to visit your broker's website, go to your profile and go to your holdings. You will get the option to pledge holdings individually for each share. You can choose to pledge all or few of your shares. Depending upon that, you need to fill in the quantity. After submitting the request, once everything is approved, the margin will be credited to your account the same day in a few minutes. If you want to unpledge the share, follow the same process and under your holdings, you can find the option to unpledge. In case you want to sell the pledged stocks directly, you can do so as it will be unpledged automatically on sale. Broadly, the procedure for all brokers would be on similar lines. However, you can check with your broker for detailed nuances. Okay, so by now, you might have understood the benefits that pledge for margin gets on the table. Like, normally, if you need funds for trading, you would have to sell your shares. With pledging, you don't need to sell. It gives you liquidity. You keep holding your share, enjoy price appreciation, and still get margin to trade. The second benefit is that even after pledging, the shares stay in your demat account, just marked as pledged. Therefore, you continue to receive dividends, bonus shares, rights issue, and other corporate benefits. And lastly, it gives you the flexibility as well, since you can pledge and unpledge anytime, no lock-in period. But one needs to be careful with the risks that come along with it. Number one is the margin call, which you might have heard a couple of times when we discuss the tricks. See, when you pledge shares for margin, the broker is trusting you based on the value of those shares. But if the market falls and the value of your pledged share goes down, the broker gets nervous. To cover the gap, they'll ask you to add more cash or pledge more share. This urgent request is called margin call. The second risk is about forced selling. If you don't provide that extra cash or extra collateral within the time allowed, the broker will sell part or all of your pledged assets in the market to recover the shortfall. The sale is at current market price, which may be lower than what you paid, so you can lock in a loss and end up with fewer long-term holdings. One last time, let's take Gagan's example to understand these two risks better. Let's say he pledges Reliance shares worth 2 lakh rupees, and after a haircut of 9%, he gets a margin of 1,82,000. Gagan uses that 1,82,000 margin to open a F&O position. Now the Reliance shares fall by 10%, so the new value of his Reliance shares would be 1,80,000. Now, when you apply 9% haircut on this new value of 1,80,000, the margin that you were supposed to get is 1,63,800 rupees. So there is a shortfall of 18,200 rupees. The broker issues a margin call asking Gagan to add 18,200 or pledge additional collateral. If Gagan is unable to add that 18,200, in that case, the broker will sell enough of his pledged Reliance shares at market price to recover that shortfall. That sale realizes a loss on those shares and also reduces Gagan's long-term holding. Therefore, you don't just lose money on the F&O trade, but you can also lose part of your long-term holdings if you are unable to meet the margin calls. So even though both the trick offer you good advantage, but should you pledge for margin or not, that actually depends on these 3 points. Number one, pledging shares gives you extra buying power, but it also doubles the risk. If you're not prepared for it, it's better to avoid. Number 2. For active traders, pledging is a useful tool to grab short-term opportunities. But for long-term investors, it can be an unnecessary risk. And lastly, pledging only makes sense if you have strict stop loss and position sizing in place. See, pledging shares can be a smart way to unlock liquidity, but only if it fits your risk plan. Otherwise, it can turn small mistakes into big losses. I hope you like this video. See you in the next one. Until then, happy investing.